Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 7th of February, and oil markets in Asia are trading essentially unchanged today so far. Brent crude oil at $78.60 and WTI $5 and further back at 73.37. Let's kick off this morning with Ole Hansen, Head of Commodity Strategy at Saxo Bank. Ole, I wish we were talking about coffee because I did enjoy that video you posted on social media yesterday, and it does seem to be a more exciting place to be than oil at the moment. This is a rather boring market that seems to be stuck in a fairly narrow band. Your thoughts on where the oil market's at 1 month into 2024?
Yeah, good morning, Sean. Well, you're absolutely right, and we could probably add cocoa to that coffee story. But the oil market is really well and truly stuck here around the 80 level in Brent. Simply, we're seeing the news flow out of the Middle East ebb and flow, but we are at no point getting close to anything that could resemble a disruption in supplies, and that's why this war premium or risk premium continues to deflate, and that attracts quite a lot of changes in positioning from traders. So it's been a range-bound market, but also been an incredible difficult market to trade. And I think some of these the extremes we've seen, highs and lows, really been driven by speculative positioning, trying to get in and out of positions. So a troubled market to trade, but the underlyings. I think we're still noting a market that's in backwardation in Brent. We're still seeing a distillate market that's look pretty tight, and we also still obviously have the concerns about the Middle East. So I think we are, as we look for at the start of the year, looking for this range-bound trading behavior around 80. And then now, just adding to this, we got the central banks or the Fed just scaling back a little bit on the market's expectations for rate cuts, but that's obviously driven from strengths because economic data continue to surprise to the upside, and that will underpin demand. And adding to that, we saw EIA yesterday lower their production estimates for this year and next as well. And that basically means if that's true, then potentially we could see no growth in U.S. production this year. And that will obviously help some of the balances to become more tight later in the year. So I think we're near a low here in the market.
That's a good segue to James McCallum, CEO and Chairman of Exergy Group and Professor of Energy at Strathclyde University. But it gives me great pleasure to see an Irish flag on his masthead photo. So that's a good thing. James, this just picking up at that point that Ole mentioned, no further increases in supply in the US this year. Meanwhile, it probably is no surprise because all of the major oil companies seem to have given all their money back to shareholders. Record profits again, are certainly very bionic ones, $80 billion in buybacks and other sort of dividends and so forth. Where do you see the oil majors going now after 2 years of bumper profits and no increase in US production?
Yeah, really good point that you make there, Sean. I mean, but not a wholly unanticipated expectation. We've talked regularly on the podcast about the fact that increased production has tended to come from reworked wells or recompleted wells in if you like the basin there. But the reality is that's not changing. If you I'm beginning to sound a little bit like a broken record, I'm afraid. But if you take a look at the share prices of the major service companies, that reflects the view that there is no real confidence that investment is going into capex anytime soon. The Schlumbergers, the Halliburtons, the Baker Hugheses of the world trading well down on where they would have been at the peak, if you like, of the Permian Basin, and indeed the major oil companies, despite if you like, their returns positioning them very, very well up the investment profile in the S&P 500 and in the US markets. The reality is the major oil companies seem to continue to be a share out of favor with the public. And I'm not entirely sure how we find our way back from that. I mean, there's clearly in the last 3 to 4 months, there's been a retraction on the part of even the European majors from their originally boyish stance on energy transition to saying no, yeah, actually on thinking about it again, we're actually principally hydrocarbon producers, and we're going to focus heavily on that area. Now, focusing heavily on that area, to me, would mean replacing depleted assets, would mean investing in new drilling activity, but that doesn't flow through to any of the stats on the Baker Hughes Rig Index, and it's certainly not flowing through into the share prices of the major service groups.
Let's welcome Yong He, founder and CEO of LNG Easy. LNG Easy, those two words together sound just like a nice coffee. Yong, I wanted to get your thoughts on where is there a sort of cuckoo in the coal mine, no pun intended, but in terms of China's appetite for LNG, it looks fairly robust. Should that give us a signal that their economic outlook is more robust than is currently expected? And so with that, oil demand may be better than expected this year. What does Chinese LNG imports tell us about the health of the Chinese economy?
I mean, I wouldn't directly correlate these two. Because natural gas consumption consists of three parts, right? In China, they had substantial domestic production. They had imported LNG, and they had pipeline gas import, from Myanmar and Central Asia and Russia. So I think even during the COVID time, consumption only down for natural gas consumption in China, only down like 1%, but then it would kind of result in a reduction for LNG import of over 20%. So it's because gas to gas competition is strong. So you can't say that really the Chinese economy is weak, therefore there's a lot of LNG import, and then if the economy is strong, then the LNG import will be stronger. I think, on balance, China is well contracted. They had contracted, more than their needs, and there's some kind of, some spare LNG for reloading purposes to serve other markets. The other day I just saw a Chinese company won a tender for a spot cargo in Japan, for example. So I think, they would, China this year will grow modestly, economy-wise, and LNG import will grow maybe 7-8%. I think, I don't know if you call that robust, but I think it's very good.
Well, certainly 7-8% in most places would be, would be welcomed, I suppose, definitely. Ole, speaking of where we find guidance or indicators, while we sort of half joked in the opening about coffee, clearly coffee is having an upward spring in its steps. But most other major commodities seem to be on a downward draft, and oil is a laggard there. Your thoughts on that? Oil has absorbed the shipping disruption in the Red Sea, obviously the conflict in Europe, and propping it up mostly is the OPEC plus supply cuts. Will oil follow other commodities downward? Your thoughts?
I don't think it will, because and actually looking at across the commodity space, the weakness that we're seeing is actually also returning to the coffee bit. It is actually in the food sector, where we got grains and soybean complex down quite heavily. It's extremely shorted market right now. The metal space is still a somewhat of a concern, but again a very mixed picture there. But generally industrial metals is really trying to take its cue from developments in China, where we're looking for additional stimulus. So I think we are the market is going through a still a bit of a correction here in terms of the overall commodities space. But if you looking at the charts, I would say we've started to stabilize, and we've been stabilizing up for the past 3 months. So I actually think we are still in the process of building a base here for the commodity sector as a whole. And one of the triggers that we're still waiting for is the clear signal that we are heading for rate cuts, and the rate cut starts to be implemented in the US. And I think that could underpin some of the restocking that we've been looking for across industrial metals, which helped bring prices down last year as yields and funding costs surge. As they start to come down, we could see some restocking. If the US avoids a recession, which it clearly looks like they will, then that will also add to the positive sentiment. So
where do you put that connection, avoiding a recession? I mean, is it these terrible sort of metaphors, soft landing, no landing? I mean, ultimately, why do rates get cut if you've got full employment, economy's thumping along, inflation's still at 3 to 4%? Why do rate cuts even come into the conversation?
Because they are relatively high historically right now. The US got a massive funding need that obviously does take is being hurt by high interest rates. So I think that if we can see the inflation start to stabilize, then they can also allow interest rates to come down, and by that stimulates not only the US but the global economy as a whole. So I think there's still that will still happen, but we also seen historically that when we move from one cycle to the next, especially into an easing cycle, volatility tends to go up. And because the market simply just trying to guess and constantly getting it wrong, the timing of these changes, and that's the phase we're going through right now, which is creating this kind of volatility, not only in the rates market but also filtering through to some of the other asset classes.
Yeah, I'm not sure the market's getting it wrong, or they're trying to bully the Fed and others into, following them into what they consider to be the la party. It strikes me, James, that Donald Trump will be screaming his head off at the Fed if they start cutting into the middle of this year, in the middle of an election cycle, while the US economy is still doing pretty well. It is the surprise, ultimately, of this current cycle, the US economy still thumping ahead. James, your thoughts on the sustainability of that and its intersection with rate cuts?
Yeah, so I like the choice of adjective, thumping ahead there. I think Ole...
Well, you've got full employment, you've got GDP growth in the fourth quarter at 3.3%. I mean, that's way above trend.
Yeah, but I think Ole makes an extraordinarily important point, which is the debt burden of the United States is enormous, and the interest rate, when it's high, is imposing very heavily on the sentiment that pervades across government. Now, the rest of the world quite clearly takes its lead from the US, particularly in Europe, and we can see that by the way that the if you like, the conversations around changes in interest rates flow. Clearly, I think the world is sitting on the fence right now, and I think that's another way of looking at what Ole is actually saying from the point of view of the commodities are sitting on the fence, if you like. The one exception, you're absolutely right, Sean, is that is in the sense of the actual markets itself, that the Dow, the S&P 500, clearly up. But there is an incredible amount of liquidity out there in the US that is still looking for a home. I said earlier on, it's not finding its way through to the share prices of the oil service sector, or indeed even the super majors, but despite huge performance. But I think everybody is sitting waiting for this trend of interest rates to cut back. And I think at that point, we'll see potentially the move that Ole is predicting. But as he rightly says, we'll have a period of volatility first.
Yong, speaking of America and obviously the election cycle that we're in and decisions that will be made during the election cycle that may or may not be otherwise sensible decisions. But one of them appears to be the decision to suspend LNG licenses for new US LNG terminals to export gas from the United States. Is that a big deal? Your thoughts on that and possible any other policy changes during an election cycle to watch out for?
Well, I think, from a moral and ethical point of view, people say that, US play a part in getting rid of Russian gas for Europe. And then, on the promise of supplying LNG. So and then now suddenly this pause. So there's a lot of kind of backlash there. I mean, Japan is kind of worried too. But I think anything they do, there's already a lot of approved projects. I think we had a very certain supply increase profile of at least 5% from this year until 2030. So that's 6 to 8 years. There's a very robust supply growth. Beyond that, I'm not
From
smart
the
enough.
US, from the US.
No, from the worldwide.
The worldwide,
Because,
okay.
we had Qataris and all that, right?
Right.
For
But this decision by Biden has little impact on that, has no impact on that.
No, not it would impact some the additional LNG 2028, 2029, and so on. So I think and most likely this will be reversed, right? If there's some kind of a change in political leadership in the U.S. I mean, Trump has famously said, drill, baby, drill, right? And the paraphrase this expression, it would be chill, baby, chill. So because gas is associated gas, it comes from the oil production
from the Permian Basin. Well, if there's going to be no extra oil this year, maybe no extra gas.
Well, so anyway, but I think I'm not so concerned for the next at least 5 to 8 years. Beyond that, it really it's anybody's guess, but I think we are comfortable for the next 5 years at least.
Well, I just welcome your thoughts on that. I mean, obviously, Europe looking at this decision in the US, again, no immediate impact, but sentiment here, I mean, Europe is essentially changing dealers from Russia to the US, becoming increasingly dependent. Does this signal any thoughts for pause?
Well, that's a good question. I don't think it. I don't think it does. We're still soldiering on as and trying to adjust our supply channels, and that will continue. So not really seeing any major development there.
And what about generally moving beyond? I mean, that the relationship or the stricture at the moment now vis-a-vis Russia and energy making its way still to the Western markets. There seems to be some signals of tighter sanctions, or at least attempts or noises around that. The Greek shippers are running away from the Dark Fleet. Generally speaking, your expectations on Russian energy getting to market as it has done. We're coming to the second anniversary of the invasion of Ukraine.
Well, it seems like I think that will continue. It's more a question right now whether they can, because we've seen some of those recent attacks carried out by Ukraine on some of their infrastructure, which basically means that some may not even be exported, and that's probably a bigger potential for driving some tightness in the market, because as we've seen now for the past 3 years, if there's a product available, then there's also a buyer somewhere prepared to pay a price. And right now, the whole system is being disrupted because of some of these attacks in Russia, but also because of the Red Sea, which basically means that millions of barrels of products have been locked up at sea, and that's also why we're seeing some of the, for instance, distillates right now being commanding a decent premium compared to what we've seen just a couple of months ago.
Let's go to the survey question, which is sort of just somewhat of a leading question, but ultimately, has the oil markets absorbed this shipping disruption in the Red Sea? At this point, all things being equal, the oil markets have absorbed the shipping disruption in the Red Sea. Agree, disagree? James, one thing that it does seem to, the Red Sea disruption, trade disruption, does appear to have localized oil markets to a certain extent, the long journey around Africa, but ultimately keeping energy in the Atlantic Basin, keeping energy east of Suez. Where does that put the energy security question? And we saw recently in Saudi Arabia the decision to postpone or suspend plans for an increase of 1 million barrels a day of oil capacity. Your thoughts on what that says for Europe? Do you expect North Sea to get more opportunity? Does it create a space for development elsewhere? How do you feel the fallout from the Saudi decision on development and E&P work in other geographies like Europe and the North Sea?
Yeah, so that's an enormous question, Sean.
Yeah.
But obviously, the most
Well,
relevant
the Saudis
question,
don't have an appetite, then who will?
Well, therein lies a look. We have clearly witnessed several fundamental changes, and we're living through those fundamental changes, which will now be a part of the future going forward. The first is that in terms of controlling production and indeed influence on price, that is almost singularly the domain of the national oil companies, and particularly national oil companies that are a member of OPEC. As we take a look at the present moment in time, we've got two war fronts, which, amazingly, very sadly, almost don't seem to make the top news items anymore, which tells us an awful lot around how quickly public perspective and opinion shifts. We've got oil prices which are stuck at around about the sort of high 70s, low 80s, and several of the speakers constantly return to the point that any other time in our history, if we had that, the oil prices would be well through the $100 a barrel at this particular point in time. So, and if you take a look at what's actually happening in terms of vessel constraint, clearly the market has adjusted or is adjusting to those constraints. Otherwise, we would have seen in the course of the last 2 weeks a significant uptick in prices. So the reality is, in that energy security question, which you actually ask, I think we've got the OPEC producers are comfortable with the influence that they can bring to bear in terms of supply and demand. They're comfortable, and we saw that in one of the press digests today, in forecasting that the world will continue to require significantly more quantities of oil going forward. But they are on top of that, and they understand that. We've got the super majors, who, as you quite rightly started off the podcast with, are continuing to follow down a path of paying back significant dividends to their shareholders. But at some point, if they are going to retract back to a strategy of principally hydrocarbon production, are going to have to invest in capex investments. Now, those capex investments may be significantly smaller than they used to be because they've got a new position in terms of the supply balance, but the reality is it's there. And then you've got the question, which we rarely talk about, which is that energy security dimension of the energy transition, which is happening in a very much slower fashion across Europe than one would originally have envisaged, governed by infrastructure constraints in terms of grid infrastructure, planning consent constraints, etc., etc. But every single one of these things, you would think at any other time, would be on the front pages of our conversation around, oil price, etc., etc. And yet they're all receding into the backdrop whilst we all seem to wait for something significant to happen. So 2 wars don't count, constraints in vessel flows don't count. A shift away from the super majors towards the national oil companies doesn't seem to count. So I come back to Ole's original point. The only thing I think which will have a massive impact, massive, not an overused word, will be the markets returning to significant growth. And the only thing that will kickstart that will be a fall in interest rates, and a significant fall.
The other situation, Yong, where there is very positive signs still in growth terms, is India at 6.5% GDP, much greater than the outlook for China and for any other part of the world. And they've just done a massive deal of LNG with Qatar. And it would appear at even below market price. What's your read on that, and where are the opportunities further for LNG growth for India?
Well, I mean, I think it's a renewing of an old deal, 7.5 million tons.
But even at a lower price.
12.2%, that's what the market says. To be honest, I wouldn't do it if I'm the decision makers now, because wait 2 months, the prices would come even further down. But anyway, I mean, sometimes renegotiation or price review happens, right?
Why do you expect a declining further in LNG prices?
I think so. I think so.
Why?
Because we have as I say, we had 5% growth for the next 7-8 years, and you had the number one market, which is Europe, 100 million tons of import. Natural gas consumption is coming down in Europe, so, and then you had the Chinese market growing single digits. Japan is declining 8%, something like that, because of the nuclear plant restarting. I mean, they have 33 plants, right? So they're only 13 they had restarted. So a long way to go. Korea has 2 nuclear plants and 2 coal-fired power plants starting this year. So these are the respectively number 1, Europe, number 2, China, Japan, Korea. This is the 1, 2, 3, 4 in the LNG importing countries. So I think really there is sufficient LNG around for a while. And
Actually,
then,
somebody was making the argument the other day that Biden did the LNG industry a favor by suspending the licensing, because it sort of it gave a slight boost to the tightness outlook for tightness in the market.
Yeah, I mean, I think to be honest, I mean, that's a very long topic, right? I'm not sure if you are prepared to talk about this now, but for me, LNG for Europe is basically gas utility, space heating and all that, and some power generation. For Japan, Korea, Taiwan, Singapore, this is power utility. But these are all rich countries. So if you go to India, you ask the question about India, Pakistan, Bangladesh, these kind of markets. Can the gas utility and power utility markets there afford LNG? This is the question, right? When you had 550 the kilocal coal at $102 per ton, which is $3.75 per MMBTU. And then you had a spot LNG price of $9.5. So basically, coal is like 40% of very cheap gas, if you like, today for power generation. So I'm not so sure whether by Mr. Biden by doing this pause has done the LNG business a favor, because beyond
a small, it's a figure, it's a sort of a more of a tongue in cheek, but nonetheless it does seem like a good. If you're ever going to suspend licenses for LNG, this might be a good time to do it, even if it's for only 9 months.
Yeah, my point is really, I think the future market for LNG will be the liquid fuel replacement in these the big global south countries.
Right.
If you look at India, how much liquid fuel they're using, oil derivatives, diesel, HFO, LPG, and so on. Bangladesh, Pakistan, the same. So I think personally, these markets are much more important than the LNG to power markets going forward. Right. So, that's kind of my holistic view of the,
Ole, I wanted to give Ole the last word to get a view, just to pick up on a previous theme. Oil markets agree, the oil markets have absorbed. But Ole, I wanted to get you, again, come back to the Russia question and Ukraine, because the U.S. have still not passed the bill. Obviously, the Senate passed a bill earlier this week that is essentially dead on arrival in the Congress, in the House of Representatives. So it's not going to pass, basically. So there's going to be a continued wait for Ukraine's funding to be able to continue this conflict. Europe has finally got there on some level. It strikes me, whichever way you cut the cake on this, we're in the end game of money supply for Ukraine's war. I'm wondering, from an energy point of view, when does that have to start figuring into the thinking? A deal is done with Putin. Why wouldn't you import his gas if you've just done a deal with him to solve a political crisis? I mean, at some point, this end games has to start dictating European energy policy, no?
Yeah, I think probably will have to, and it's probably already taking place. And again, probably some countries are looking beyond the current situation to the next phase. I think I've said all along that we will be buying Russian gas again someday. Obviously in much reduced quantities compared to what we did. We fell asleep by the wheel, being supplied by an abundance of cheap gas. That will not happen again. But we will be buying Russian gas, and hopefully we have to. We need to. We need this world coming together instead of being disjointed. But whether we are there right now, that remains to be seen. But we are moving in that direction. But clearly we need to find a solution first that can be accepted from both sides.
Yeah, well, that's certainly true in any of these conflicts that are currently going on. But I suppose the absence of money might be one that helps to come quicker to an end game than the other. We'll have to wait and see. But it strikes me that has to become part of the thinking. Halftime Talk interview this week with the Secretary General of IEF will just be published following this podcast. But thank you so much, Ole Hansen in Denmark. Great to have your thoughts and congrats. I believe you have a new king. And James McCallum, you don't have a new king, but nonetheless, you can be the king. Yong, hey, thank you so much. Really appreciate your thoughts and your insights. All the best and take care.
Thank you.
Thank you.
Thank you very much. Thank you. Yes, yeah, thank you.